Alex joined the program because he was afraid of missing payments. The first instruction they gave him was to stop making them. That is the strange heart of debt settlement, and it is where the story begins. Alex was carrying serious credit card debt, paying every minimum on time, and getting nowhere. A company promised to cut what he owed if he would stop paying his creditors and send the money to them instead. For a while, it felt like a plan. Then the letters changed. Then the phone changed. Then a lawsuit arrived. Here is what really happens in those quiet months, and what to check before you ever sign. Start with where Alex was standing when the advertisement found him. Several credit cards. Balances that had crept up through a car repair here, a slow month there, a stretch where groceries went on plastic. He wasn't reckless, he was tired. Every month he paid the minimums on time, like clockwork. And every month the balances barely moved because most of what he sent was disappearing into interest. It felt like bailing water with a spoon. Then, one night, scrolling on his phone, he saw it. Cut your debt by up to 50%. One affordable monthly payment. Become debt-free faster. There was a smiling couple, a phone number, a promise of certainty in a part of his life that had none. He called. And the representative was good, not pushy, warm, patient, confident. She explained that the company negotiated with credit card companies every day. That Alex would make one monthly deposit into a special account, smaller than all his minimum payments combined. That once enough money built up, the company would negotiate settlements for less than he owed. There was a plan. There was an end date. There was hope. Then came the instruction. To make it work, Alex would need to stop paying his credit cards. He went quiet. Missing payments was the one line he had never crossed. The representative had heard that silence before. She explained, gently, that creditors don't negotiate with people who pay on time. They negotiate when they see hardship. Falling behind, she said, was part of the strategy. And here's why Alex said yes, and why so many people in his position do. He was already sending money every month and getting nowhere. The new deposit was smaller than his combined minimums, so it felt like relief. He was ashamed of the debt and relieved that someone would finally handle it for him. And the person on the phone sounded like she had done this 1,000 times. When you are exhausted, confidence sounds like competence. He wasn't being stupid. He was being human. So let's be clear about what he actually signed up for, because this part matters. Debt settlement is not a loan, and it is not a payment plan. A for-profit company offers to negotiate with your creditors to accept less than the full balance, usually as a lump sum. While you wait, you deposit money month after month into a dedicated account. If a provider covered by the federal telemarketing sales rule requires one of these accounts, the account must meet specific protections. It has to be held at an insured financial institution. The money in it belongs to you. The provider cannot control the company administering the account, and you can generally withdraw your funds and leave the service without a cancellation penalty, minus any settlement fees the provider has legitimately earned, and any reasonable account administration costs. Just as important as what the account is not. The money is not automatically going out to your creditors each month. A deposit is not a settlement, and the account itself does not protect you from collection activity or from a lawsuit. It is just accumulating, waiting for the day there might be enough to make an offer. And that word might is doing a lot of work, because creditors do not have to say yes. No settlement company controls them. Some creditors negotiate. Some follow their own internal policies. And some large credit card companies, as federal regulators have documented, have policies against negotiating with settlement companies at all. No honest company can guarantee a percentage because the other side of the table hasn't agreed to anything. It is worth pausing to separate debt settlement from things it gets confused with because they are very different animals. Debt consolidation replaces several debts with one new loan, and you still repay what you borrowed. Nonprofit credit counseling offers guidance and sometimes a debt management plan where you keep making payments through the counseling agency while they seek lower interest rates or waived fees. you generally repay the full principal, but the bleeding slows, and you typically are not told to stop paying. Bankruptcy is a court process with its own rules, consequences, and protections, and direct negotiation is simply you calling your creditor's hardship department, asking what they can do. Different tools, different risks. None of them is right for everyone. Only one of them is usually built on the strategy of deliberately not paying. For Alex, the first weeks actually felt calm. He made his first deposit, then his second. The number in his settlement account started to grow, and watching it grow felt like progress. But somewhere in a credit card company's computer, a different number was growing too. 30 days after his first skipped payment, the first account was reported late. Then 60 days. Late fees appeared, penalty interest on some accounts, kicked the rates even higher. The balances he was supposedly settling were getting bigger while he waited. His phone started ringing at lunch, then at dinner. Letters shifted from polite reminders to something colder. His settlement account was growing. So were the debts outside it. And this is the mechanism most people never see in the advertisement. During the saving up phase, which can take months or years, nothing is protecting you. Enrollment is not a legal shield. Joining by itself does not automatically stop collection calls, late fees, interest, charge-offs, negative credit reporting, or lawsuits, and no settlement company can stop a creditor from deciding it would rather go to court than negotiate. Whether any particular creditor sues depends on the creditor, the amount, and the circumstances. Nobody can promise you it won't happen. Alex didn't know that. He thought the company had, in some official way, taken over. Then came the envelope. At first he thought it was another collection letter, and he almost set it aside unopened. But it looked different, heavier. Through the window of the envelope, he could see the name of a court. Inside was a summons. His name, spelled correctly, which somehow made it worse. The name of one of his credit card companies. An amount larger than he remembered owing, swollen by months of fees and interest, and a deadline, a real one with legal weight behind it. His hands were not steady when he called the settlement company. He assumed this was the moment they earned their fee. And the voice on the phone was still friendly, still calm, as it explained that the company does not represent customers in court. They could try to negotiate, but a lawsuit was between Alex, the creditor, and a judge. He had paid for negotiation. He had not bought legal protection. If you ever find yourself where Alex was standing, holding court papers, the single most important thing to understand is this. A properly served lawsuit does not go away because you ignore it. Read everything. Find the deadline. Respond by it, on your own or with qualified legal help. Responding does not mean you are admitting that the debt is valid. It preserves your opportunity to challenge the claim, and it requires the collector to prove its case. If you do not respond, the court may enter what is called a default judgment against you. That can allow the creditor to obtain a judgment without your side being heard, and it can make the debt much harder to challenge afterward. Legal aid organizations, consumer attorneys, and court self-help centers exist for exactly this moment. The deadlines, the procedures, and the consequences vary by state and by court, which is one more reason to take the papers seriously instead of guessing. And a judgment changes the landscape. Once a creditor holds one, depending on the state, doors can open that were closed before. Wage garnishment, money taken from bank accounts, liens against property. Not automatically, not in every case, and every state has its own limits, exemptions, and protections. But the polite version of collection is over. That is what was at stake inside that envelope Alex almost didn't open. Now, about the fees, because this is where the math gets quietly interesting. For debt relief providers covered by the Federal Trade Commission's telemarketing sales rule, settlement fees generally cannot be collected in advance. Three things generally have to happen first. The provider must actually settle, reduce, renegotiate, or otherwise change the terms of at least one of your debts. There must be a written agreement with the creditor that you have accepted, and you must have made at least one payment to the creditor under that agreement. That rule exists because before it, companies collected thousands of dollars in advance from desperate people and often settled nothing. But notice what the rule does not mean. It does not mean the service is cheap, and it does not mean you are protected from disappointment. Fees are typically charged account by account as each one settles, often calculated as a portion of the enrolled debt or a share of the claimed savings. The dedicated account usually carries its own small administration fees. And if some creditors settle while others refuse, you can pay real fees on the settled accounts while the unsettled ones keep growing or head to court. Let me show you how the advertised savings can shrink with one clearly made-up example. Every number here is hypothetical just to show the shape of it. Say Alex owes $10,000 on one card. He stops paying. Over the following year, late fees and interest push that balance to $12,000. Eventually, the creditor agrees to settle for $6,000. The advertisement math says he just saved half. But now add the settlement company's fee. If that fee is 20% of the original enrolled debt, that is $2,000. Add, say, $100 in account fees over the program. So Alex pays $6,000 to the creditor, $2,000 to the company, $100 to the account, $8,100 to resolve what began as a $10,000 debt. Real savings, about 19%, not 50%. And that is a case where the negotiation worked. There's one more letter that can show up long after the collection calls stop, and it comes from the tax side. When $600 or more of debt is canceled, you may receive a form called Form 1099-C, showing the canceled amount. That form is a reporting document. It does not, by itself, determine how much is taxable. Canceled debt is generally taxable unless an exception or exclusion applies, including certain bankruptcy and insolvency situations. Insolvency means, roughly, that you owed more than you owned when the debt was canceled, and how it applies depends entirely on individual facts. State tax treatment can differ too. This is a moment for current official guidance or a qualified tax professional, not a guess. In our made-up example, that $6,000 of forgiven balance could, for some people, carry a tax cost that shrinks the real savings even further. The credit report tells its own version of the story. The missed payments that the strategy required can be reported. Charge-offs and collection accounts can appear, and an account settled for less than the full balance may be reported differently from one paid in full, which future lenders can see. How much any of this moves a score depends on the person's file and the scoring model, so be suspicious of anyone who promises you an exact number in either direction. Inaccurate negative information generally cannot simply be wiped away because a company says so. The advertisement showed Alex the settlement amount. It did not show him the years he might spend rebuilding trust with lenders afterward. So how do you tell a dangerous company from a legitimate one? Watch for the signals regulators keep flagging. A company that wants its fee before it has settled anything. A company that guarantees a specific percentage or promises every creditor will settle, because no one can promise what a creditor will do. Claims that some new government program will erase your credit card debt. Promises to stop all collection calls and lawsuits. Instructions to cut off all contact with your creditors. Vague answers about fees, about how long the program takes, or about how much you must save before the first offer is even possible. Any suggestion that the money in the dedicated account is not fully yours. And pressure. Legitimate options survive a night of thinking. A company that needs you to sign today is telling you something. And before anyone enrolls in anything, there are questions Alex wishes he had asked. Is the company for profit or a nonprofit credit counselor? Because those are different worlds. Where exactly does each monthly deposit go? What happens if a creditor refuses to negotiate? Will anyone represent you if you get sued? and get that answer in writing? When are fees charged, and how are they calculated? How long is this expected to take, and how much has to accumulate before the first offer? What will this do to your credit, and what could it mean at tax time? And has anyone compared this against the alternatives? Because there are alternatives. Calling the card company's own hardship department, which sometimes has programs the advertisement never mentions, direct negotiation, a non-profit credit counselor, and a debt management plan, consolidation, when the new terms genuinely improve things rather than just stretching them, a consultation with a consumer attorney or a bankruptcy attorney, when the debt is truly unaffordable. Bankruptcy is not a failure, and it is not a free pass. It is a legal tool with real consequences, and for some people, it is safer than years of missed payments and uncertainty. A difficult option you fully understand can be safer than an attractive one you don't. Alex's story settled down eventually, in the ordinary, unglamorous way these things do. Some accounts were resolved. The lawsuit was eventually addressed, late and stressfully. What stayed with him was not only the money, it was the realization of what he had actually bought. He thought he had hired someone to make his creditors disappear. Instead, he had stopped seeing the payments, while the consequences kept growing in the dark. A settlement promise is not a settlement. A deposit is not a payment to a creditor. Enrollment is not legal protection, and a lower negotiated balance is not the same as a lower total cost. They promised to negotiate his debt. They never promised his creditors would wait. If this helped you recognize the risk before it became yours, subscribe to Money Traps Explained. The most dangerous debt plan is not always the one with the highest payment. Sometimes it is the one that makes the risk feel invisible, right up until an envelope from a court proves it never was.